I'm Nikita Agrawal, and I'm a researcher based at the University of Oxford, affiliated with the Faculty of Law and the Oxford Internet Institute. I'd like to thank the organisers of this workshop for the kind invitation to speak today. In this presentation, I want to offer a legal and regulatory perspective on navigating normative trade-offs in the use of machine learning for consumer finance. And to illustrate this perspective, I'll use a case study of machine learning in consumer credit markets, specifically in consumer credit scoring, or what I refer to as algorithmic credit scoring. I should note that much of what I will say in this presentation is based on my recent paper, The Norms of Algorithmic Credit Scoring. So to begin with, a brief roadmap of where we're going in the next 20 minutes or so. First, I will introduce algorithmic credit scoring. Next, I will identify the key normative goals that frame the regulation of algorithmic credit scoring. Although I'll focus on regulation and regulatory norms in the UK and EU, this analysis will also be relevant to other jurisdictions in which similar normative considerations arise. Third, I will examine the implications of algorithmic credit scoring under each of these normative goals. And fourth and finally, I will consider how we might best navigate normative trade-offs and strike an appropriate balance between different normative goals through both market self-regulation as well as public regulation. So what is algorithmic credit scoring? Well, in general terms, credit scoring describes the use of statistical methods to classify and rank consumers according to their credit risk. This practice has been around for a while and is most prominently used by lenders to decide whether to extend credit and at what price. Traditionally, credit scoring has relied on linear statistical methods and a limited number of fixed variables to calculate the borrower's credit score. Of these, credit repayment history is typically the highest weighted variable. As such, credit scoring has traditionally been based on credit data. Algorithmic credit scoring builds on traditional credit scoring in two principal ways. First, by leveraging a much larger volume and variety of data, so-called alternative data. Alternative data used for algorithmic credit scoring include both non-credit financial data, such as mobile phone payments, as well as non-credit non-financial data, such as social media data. Alternative data are also typically less structured and more feature-rich than traditional credit data. Secondly, algorithmic credit scoring is defined by the use of more sophisticated machine learning and deep learning techniques to analyze these data, such as random forests and artificial neural nets. In this respect, the algorithmic in algorithmic credit scoring refers primarily to the use of these more sophisticated machine learning algorithms. The growth of algorithmic credit scoring presents both opportunities as well as risks for credit consumers and for the functioning of consumer credit markets. Of course, this is not an entirely novel insight. The growth of credit scoring and credit reporting more generally over the past several decades has also brought opportunities as well as risks, particularly with regard to fairness in lending and consumer privacy. However, the growth of algorithmic credit scoring, and with it the vastly greater reliance on personal data and behavioral profiling in consumer lending, has amplified these concerns and normative tensions. The key challenge in regulating algorithmic credit scoring is finding an appropriate balance between its various harms and benefits, and thus balancing different regulatory norms or normative goals. In the EU and UK, the key regulatory norms in this regard are allocative efficiency, distributional fairness, and privacy as autonomy. These are collectively the key norms that underpin EU data protection and consumer credit regulation, which are the primary regulatory frameworks that govern algorithmic credit scoring in these jurisdictions. So what do each of these goals mean? Well, briefly, consumer credit markets might be considered allocatively efficient, where capital is allocated to the most valuable projects, i.e. borrowers who are willing and able to repay on time and without incurring financial distress. Distributional fairness in consumer credit markets can be interpreted in various ways. This includes equal opportunity of access to credit for similarly situated consumers, fair pricing of credit based on an accurate assessment of creditworthiness, and the absence of unfair discrimination, particularly on the grounds of protected characteristics such as race and gender. Finally, privacy as autonomy refers to the goal of controlling and limiting the use of personally identifiable information, such that consumers may have a reasonable opportunity to shape their own identities and thus exercise their autonomy. Examining algorithmic credit scoring in light of these three norms reveals a highly nuanced picture in which algorithmic credit scoring generates both benefits as well as harms within and between each normative axis. That is, it gives rise to inter as well as intra-normative trade-offs and areas of normative alignment. So let's consider first some of the implications of algorithmic credit scoring for allocative efficiency in consumer credit markets. On the one hand, more accurate creditworthiness assessment due to the use of machine learning and alternative data stands to enhance allocative efficiency in these markets. Note that this includes the more accurate assessment of both credit risk to the lender and affordability of credit for the borrower, which are the two components of creditworthiness assessment under UK law. On the other hand, however, lenders may use their data-driven insights or abuse their insights due to algorithmic credit scoring and the use of machine learning and alternative data more generally to exploit consumers in ways that are inefficient, for example, by targeting vulnerable borrowers with unfavorable credit offers. Better access to credit due to algorithmic credit scoring also stands to enhance distributional fairness in consumer credit markets, specifically by improving credit opportunities for thin-file consumers who lack the credit data traditionally required to demonstrate creditworthiness. These borrowers are more likely to come from low-income and ethnic minority backgrounds. Likewise, the use of more automated machine learning-driven credit decision-making could reduce direct discrimination in lending due to the personal animus of loan officers. At the same time, however, there is a demonstrated risk that bias and proxy variables in the data used to develop machine learning scoring models could generate new avenues for indirect discrimination. A related fairness concern is that certain high-risk borrowers who are previously being subsidized by a lack of or hidden information will be harmed by the improved observability of their negative characteristics due to algorithmic credit scoring. Although more accurate price differentiation in this way may be considered an efficient outcome, it's likely to have regressive distributional effects. When it comes to the goal of safeguarding consumer privacy and therefore consumer autonomy, algorithmic credit scoring, with its heavy reliance on personal data and behavioral profiling of consumers, presents itself primarily as a threat. This is due to the ubiquitous data collection and surveillance of consumers entailed not only by algorithmic credit scoring, but also the broader apparatus of algorithmic decision-making in which it is situated. Likewise, the knowledge that all data is credit data constrains consumers from acting freely, given that any of their behavior could now impact their creditworthiness. And given that inferences drawn from alternative data are often less intuitive than those based on traditional credit data, such as credit history, consumers risk losing significant control over their financial identities and how these identities are being constructed. So we can see that algorithmic credit scoring gives rise to a range of benefits and harms along and within each of the three normative axes. The regulatory question to which we now turn is whether existing mechanisms and institutional arrangements under data protection and consumer credit regulation specifically are appropriate for balancing these harms and benefits and navigating normative trade-offs in the regulation of algorithmic credit scoring. For the purposes of today's presentation, I will focus on the privacy and autonomy trade-offs and consider how regulation might best navigate them. So to recap, we've seen that the use of personal data for algorithmic credit scoring stands to benefit consumers and the functioning of consumer credit markets by supporting efficient credit allocation and improving access to credit for marginalized consumers. However, the same processing of data also has costs, as we've seen, particularly where it threatens consumer privacy and autonomy and undermines allocative efficiency and distributional fairness due to rent seeking by lenders and the exploitation of vulnerable consumers. This points to scope for normative alignment between the goals of privacy or autonomy, allocative efficiency, and distributional fairness, whereby a certain level of consumer privacy is necessary for well-functioning, efficient, and fair consumer credit markets. One way of mitigating the harms to consumer privacy, and therefore achieving the desired normative balance, could be through the adoption of privacy-enhancing technologies by both consumers as well as firms. This includes privacy-preserving web browsers and decentralized data management platforms that offer consumers greater control over the use of their personal data and the construction of their identity. Indeed, privacy self-management by consumers in this way should, by definition, be autonomy-enhancing. Additionally, firms can embed privacy and data protection into the design of their products, for example, by making data minimization and privacy-preserving techniques, such as federated machine learning or data de-identification using differential privacy, the default, Indeed, there is nascent evidence of consumer credit and other financial services firms, at least in the UK, using anonymization and synthetic data techniques. More broadly, the leading web browsers have committed to phasing out the use of third-party cookies, thereby reducing the scope for consumer tracking. Apple iOS employs federated machine learning and differential privacy, amongst other examples. However, whilst these tools can certainly play a part in protecting consumer privacy, their effectiveness really depends on the extent to which they are fully adopted by firms and consumers. In practice, the adoption of privacy-enhancing technologies is greatly impeded by the market failure in datafied consumer credit markets, markets that are characterized by steep asymmetries of information and power between lenders and borrowers, behavioral biases of consumers, and negative externalities to data processing. For example, the future-oriented, uncertain, and intangible nature of many privacy or autonomy harms, a data hack or identity theft that may not happen, means that consumers easily discount their severity due to optimism and present biases. Consumers also struggle to fathom the aggregate harmful effects of individual data transactions on their privacy and autonomy, particularly over the long term. The nature of feature-rich, unstructured personal data means that consumers often reveal more information than they would prefer or are aware of when handing over those data. Likewise, consumers are unable to internalize the undesirable social costs to the privacy and autonomy of other consumers due to the use of network data. These are the negative externalities of data processing. In the presence of these behavioral and structural obstacles, consumers alone are unable to adequately mitigate the risks to privacy and autonomy due to algorithmic credit scoring through the adoption of market-based privacy-enhancing solutions. For the same reasons, the market alone does not create strong enough incentives for firms to optimize for privacy, for example, by favoring the use of de-identified data or more generally reducing the scale of personal data processing, if doing so would reduce the predictive and therefore commercial value of the data. The inadequacy of individualized market-based solutions in safeguarding consumer privacy in consumer credit markets therefore calls for a strong collective response through regulatory obligations on firms to protect consumer privacy. Indeed, the existing data protection regime in the EU under the General Data Protection Regulation, or GDPR, establishes various mechanisms that are designed precisely to control data processing and safeguard consumer privacy. This includes individual market-based mechanisms, such as informational rights to access one's data and to receive information about automated decision-making. It also includes obligations for data processors and controllers, including an obligation to carry out a data protection impact assessment whenever the proposed data processing carries high risks to fundamental rights, such as the right to privacy and data protection, obligations to adopt technical and organizational measures that implement data protection by design and default, and obligations to comply with overarching data protection principles, such as data minimization and purpose limitation. However, the effectiveness of market-based informational remedies under this regime is undermined by the same market failure that we discussed earlier. Due to informational asymmetry, negative externalities to data processing, and well-known behavioral biases, consumers are unable to use these individual rights-based mechanisms to effectively manage their own data and therefore their privacy. This leaves the data processing obligations of data processors and controllers, the second category of remedies under the GDPR. In practice, however, these provisions have been inadequate for safeguarding consumer privacy, particularly in consumer credit markets. Whilst there is anecdotal evidence that lenders in the UK are carrying out data protection impact assessments, these are often treated as a tick box compliance exercise. The failure of DPIAs and data protection by design obligations under this regime in mitigating the privacy risks to credit consumers is in large part due to weaknesses in regulatory design and enforcement. The GDPR puts the onus on firms to implement these obligations and affords them considerable discretion in how they do so. However, to be effective in holding firms accountable, this more discretionary, process-oriented, and principles-based approach needs to be accompanied by close regulatory oversight of and engagement with regulated firms, including through effective sectoral regulatory guidance and enforcement. As such, existing data protection and consumer credit regulation do not adequately safeguard the privacy of credit consumers and therefore fail to strike an appropriate normative balance in the regulation of algorithmic credit scoring. The under-regulation of data protection this way has resulted in a data protection and consumer privacy gap in UK consumer credit markets. Striking an appropriate balance between the norms of algorithmic credit scoring therefore requires a stricter public regulation to safeguard consumer financial privacy. This requires regulatory reform on two levels, substantive and institutional. At the substantive level, consumer credit firms should be required to meet a higher burden of proof for the processing of personal data than under the existing data protection regulatory regime. This should include stricter and more specific obligations for firms to demonstrate that the processing of personal data for algorithmic credit scoring yields a sufficiently significant improvement in the accuracy of creditworthiness assessment in order to be justified as necessary and proportionate under a DPIA. It should also be clarified that data protection impact assessments are mandatory for algorithmic credit scoring, as well as the use of other data-driven risk assessment technologies in consumer credit. However, even these reforms may not be enough. The case-by-case contextual approach to assessing risks under a DPIA may be fundamentally inadequate for mitigating the systemic privacy harms to consumers due to practices such as algorithmic credit scoring, particularly other consumers in other contexts. And the proposed accuracy test is likely to have regressive distributional effects, given that it is more likely to justify data processing as necessary and proportionate for thin-file borrowers. As noted, these consumers are more likely to come from low-income and ethnic minority backgrounds. Consideration could therefore be given to imposing hard limits on the types and granularity of personal data that can be used for algorithmic credit scoring and in consumer lending more broadly. This includes a prohibition on the processing of certain types of data, such as relationship, fitness, or social media data, data that are feature-rich and more likely to reveal personal details intrinsic to a person's identity. Likewise, the use of certain data minimization and de-identification techniques could be made mandatory. Of course, de-identification doesn't mitigate all privacy harms, for example, due to group-level profiling and surveillance, but it does minimize some of these harms while still striking a balance with the other normative goals of regulating algorithmic credit scoring, particularly allocative efficiency. At the institutional level, there's a need for an evolution in the regulatory architecture governing consumer credit markets, as these markets become increasingly datafied and data protection and privacy become increasingly important normative goals of consumer credit regulation. In particular, more of the responsibility for enforcing data protection, which in the UK currently resides with the cross-sectoral data protection regulator, the ICO, should be shared with the sectoral financial regulator. In the UK, this means the Financial Conduct Authority, or the FCA. As a sectoral regulator that has a close relationship with consumer credit firms, the FCA is likely to be in a better position to monitor and enforce their data protection obligations. The FCA also has greater sectoral expertise and experience to assess whether firms are making appropriate value trade-offs, for example, under a DPIA. Moreover, data protection and consumer privacy naturally fall within the FCA's existing consumer protection mandate. Data protection is consumer financial protection. Finally, to complement public regulation, the consumer credit industry could usefully develop data protection guidelines or codes of conduct, adding to existing industry self-regulations such as the Standards of Lending Practice, formerly known as the Lending Code. Similar consideration should be given to the development of privacy-supporting technical standards and data management architectures. Thank you for listening, and I look forward to any questions.